Today, we're diving into something that could reshape everything you think you know about the American economy. We're talking about a debt tsunami sweeping through Silicon Valley, a crisis hiding in plain sight that most analysts are afraid to even acknowledge. We'll expose why the biggest names in tech are suddenly borrowing like there's no tomorrow, what Wall Street is quietly saying behind closed doors, and why some experts believe we're watching the setup for the next great financial reckoning. And yes, I've saved the most jaw-dropping revelation for the very end of this episode, so stick around. I spent years inside one of the major news networks, and let me tell you, I saw firsthand how stories got shaped, how facts got bent to protect the powerful, how narratives got crafted to keep you comfortable. I couldn't stomach it anymore. So I left. Now I work independently, I answer to nobody, and I bring you the unfiltered truth about what's really happening in our world. Before we go further, I need your help. If you find value in what I do here, hit that like button, subscribe to this channel, and if you can, please consider becoming a sponsor. We put in serious hours fact-checking every claim, verifying every source, making absolutely sure we're not feeding you fake news or propaganda. That takes time, resources, and commitment. Your support makes this mission possible, and I mean that from the heart. And remember, stay until the end, because what I'm about to reveal in the final minutes will completely reframe everything you think you understand about this situation. Let me paint you a picture. For over a decade, big tech lived in a fantasy world. They were swimming in cash, investors worshipped them, and debt was something other companies worried about. But something fundamental has shifted. Right now, as we speak, the giants of Silicon Valley, Alphabet, Meta, Amazon, Microsoft, Oracle, they're all doing something they never really needed to do before. They're borrowing massive, truly staggering amounts of money, and they're doing it at a pace that's making even seasoned Wall Street analysts nervous. This year has witnessed a record-breaking stampede into corporate bond markets. Alphabet raised over $17 billion in the United States alone. Then they crossed the Atlantic and grabbed another 6.5 billion euros in Europe, one of the continent's biggest deals all year. But that's nothing compared to Meta. They went absolutely nuclear with a $30 billion bond sale that attracted an order book of $125 billion. Let that sink in. That's the largest order book ever recorded in history. Even Oracle jumped into the frenzy, selling $18 billion to bankroll their data center build-out. Now, some investors look at this buying mania and think, great, everyone's confident, everything's fine, nothing to see here. But here's what they're missing, and this is where things get truly interesting. Other investors, the ones who've been around long enough to remember what happened before, they're seeing warning signs everywhere. Morgan Stanley just dropped a bombshell estimate. They're projecting that big tech's AI ambitions could require as much as $1.5 trillion in new debt by 2028. JP Morgan strategists are forecasting that capital expenditure needs for the major hyperscalers, that's your Amazons, your Microsofts, your Googles, will hit around $570 billion for 2026 alone. That's more than 4 times what they spent just a couple years ago. 4 times. When that much debt floods into bond markets, it doesn't just disappear quietly into the system. Analysts are warning about something they call supply indigestion. That's when investors simply cannot absorb new bonds fast enough without demanding higher and higher compensation for the risk they're taking on. Think about what that means. Even top-tier borrowers, companies with balance sheets that were once considered bulletproof, even they're starting to see spreads widen. The whole credit spectrum is getting rattled. And this pressure isn't staying locked inside American borders. Europe is getting hit too. European investors are hungry for high-quality US tech exposure, so they're absorbing a growing share of these mega deals. But here's where it gets really concerning, and most people aren't talking about this yet. It's not just the giants issuing debt anymore. Hedge fund researchers are now pointing to a wave of lower-rated borrowers piling in. Smaller cloud providers, former Bitcoin miners who suddenly reinvented themselves as AI hosting firms, they're all jumping in because they don't want to miss out on what they think is the gold rush of the century. These companies are building aggressive timelines, signing lease agreements that promise big returns somewhere down the road at some magical point in the future. But analysts at firms like Meng Group are asking the question that should terrify anyone paying attention. Can markets actually stomach this much lower quality supply tied to a sector whose long-term economics remain incredibly uncertain? And that uncertainty, my friends, that's not going away. In fact, it's quietly growing. Here's a number that should make you pause. One MIT initiative reported this year that 95% of organizations using generative AI are seeing zero meaningful return on investment. Zero. Nothing at all. Not a little bit of return, not marginal gains. Absolutely nothing. So for lenders, the question has completely shifted. It's no longer about whether these companies can build the data centers. The real question is whether they can ever actually monetize them. Can they turn all this infrastructure, all this borrowed money into real profits, or are we watching the setup for a spectacular collapse? Some investors are already hedging their bets. According to recent reports, derivatives trading tied to potential tech company defaults is rising. That's a massive red flag. It signals a subtle but very real shift in sentiment. Now, they're not predicting outright collapse, not yet, but they're acknowledging that refinancing risk becomes dangerously real if the broader economic environment weakens, and when trillions in fresh debt meet rising interest rates or a downturn in tech earnings, something we've absolutely seen before, even the strongest balance sheets start to crack under the pressure. But here's the puzzle. Demand hasn't collapsed yet. And that's what makes this whole situation so bizarre. Remember in my previous video, I explained how the AI industry is being propped up by massive, and I mean truly massive, government-driven investments. This isn't just Washington throwing money around. We're talking about governments worldwide viewing AI not merely as technology, but as a geopolitical weapon. With global cash continuing to pour into fixed income funds, many buyers see these bonds as a rare chance to lock in exposure to the world's most profitable companies. Nobody wants to miss out. That's human nature. But let me give you a harsh dose of reality. Beneath all this optimism, a deeper and far more troubling shift is unfolding. Morgan Stanley's analysts have warned that big tech's financing strategy, taking on enormous amounts of debt without producing substantial returns, introduces a dynamic that credit markets haven't seen in decades. And here's the kicker. Issuers are no longer sensitive to price. When the biggest borrowers in the world are willing to pay almost anything to push forward their strategic AI projects, they distort pricing for everyone else. Think about what that means for valuations. Those soaring sky-high valuations that have been raising alarms throughout the industry. Smaller companies may have no choice but to match those premiums, even if it completely strains their own credit profiles. So we end up with this paradox that we're all watching unfold in real time. Big tech's balance sheets remain some of the strongest in the world. Their bonds are still considered exceptionally safe by most standards, but the sheer volume of supply, combined with the completely untested economics of generative AI, is creating tension across the entire market. Investors are getting nervous because a sector that was once viewed as an unstoppable cash cow is now relying on leverage on a scale that rivals Wall Street's most capital-hungry industries. Let that reality settle in. On the surface, the AI boom promises extraordinary breakthroughs, life-changing technology, solutions to problems we haven't even fully understood yet. But as this debt wave rises, and believe me, it's rising fast, investors are asking a more fundamental question. Is the future being built on sustainable foundations, or is the world sleepwalking into the next credit bubble? Which one is it? The answer to that question will determine the fate of the US economy in the short term, and many global economies too. For now, the answer might depend on whether the billions being poured into AI data centers eventually generate real, tangible returns, or whether, like so many technology manias before it, the promise of tomorrow is being financed by debt that the market simply isn't ready to absorb. History has shown us this pattern before. We've seen it with the dot-com bubble, we've seen it with the housing crisis, we've seen it over and over again. Are we watching it happen one more time? So let me bring this all together for you. We've uncovered a record-breaking borrowing binge by the world's biggest tech companies, a debt wave that could hit $1.5 trillion by 2028. We've exposed the fact that 95% of companies using generative AI are seeing zero return on their investments. We've revealed that even Wall Street insiders are quietly hedging against potential defaults. And we've shown you how this isn't just an American problem, it's spreading across Europe and creating distortions in global credit markets. The question you need to ask yourself is simple. Are we building the future, or are we financing the next collapse? If this analysis opened your eyes to what's really happening, do me a favor. Hit that like button, subscribe to this channel, and if you can, please consider sponsoring our work. We're out here every single day digging through reports, fact-checking claims, refusing to sugarcoat the truth just because it makes people uncomfortable. That's the promise I made when I walked away from the mainstream machine, and it's a promise I intend to keep. Thanks for watching, and I'll see you in the next one.